Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I'm a divorce valuation expert in St. Louis, Missouri. I have the pleasure of discussing fraud in times of divorce and following the money trail with Jason Pierce, a forensic accountant in Boston, Massachusetts. Welcome, Jason.
Thank you. It's great to be here.
Yeah. So do you have like a Boston accent, or is that just, does everybody ask you that? You're not even from Boston, right?
Right. Yeah. Strangely, my dad was in the military, so I have one of those like conglomerate sort of accents. I did go to school, high school and college in Tennessee, so when I'm down there, it comes out. But no Boston.
Oh, wow. I love a Boston accent. Anyway,
Yeah.
so tell us a little about, so since we're talking about divorce and fraud, which are kind of two things that you're highly interested in and focused in, how did you get involved in even doing valuations for divorce?
Yeah. So it, like a lot of practitioners, I kind of stumbled upon it. I mean, for my background, I started in auditing and in some tax, but one of my tax clients got divorced. And she said to me, like, hey, can you just come tell us like what the value of this fishing business is? And I'm like, sure. Didn't know anything about it. And I'm glad that the statute of limitations is closed on that. But basically that one was more of they didn't make any money. So it was really just the vessel itself. But that was interesting. And looking back, maybe sparked it, but we merged in with another firm that did business valuations. And so I got to work on some of that. And it just got me thinking from an audit perspective where you're just looking backwards, like, hey, how did we do last year, to, business plan valuation looking forward. It was much more interesting to me. And especially with the tax return, just like filling out forms and checklists and things, I'm just not that way, turns out. So.
Well, and I think that that's how a lot of people in the valuation space stumble upon it, right? Like we are doing valuations for traditional reasons, estate planning, partnership issues, and things like that. But then people are getting divorced and business owners are getting divorced. And the concept is that most of the time a business has to stay with one of the parties. There's some states that will allow you to have the business with both parties. And it brings up an interesting concept that everything is different in different states. So I'm in Missouri and I do a lot of work in Missouri and Illinois. You're in Massachusetts. And quite frankly, the laws and the cases that set the precedent are different in each of these states.
Yep.
So you kind of have to know what you're doing in that state, not just with valuation, right?
Yeah, definitely. And we did that skip over in Alaska part, but in Alaska, say it's a fair market value state, and they have nuances, say passive appreciation, and people argue about the discounts, whereas there's no alimony. But in Massachusetts, there's alimony. Heavy lately. It seems like a lot of people are focused in on this personal goodwill issue. We could talk about that, but alimony. And to your point, yeah, like New England's pretty packed together. If you go across the border, New Hampshire is a fair market value state, but Massachusetts is fair value. So, and there's a case law on that. And so what does that mean from a fair market value versus a fair value perspective? And I see this sometimes where people come in out of state, they just apply what it is in their state to what the state that they're working in. And that can backfire oftentimes. So.
Oh, it can really backfire. I mean, I think that people conceptually think that you can do this work in any state if you know how to do valuations. But, in Missouri, we have some interesting cases that dictate how we have to do certain things. And so let's talk about, what are some of the unique divorce cases related to valuations in Massachusetts that maybe, people need to be aware of, especially if you're a business owner, but also the attorneys and things like that. Like what are, even just one or two cases that we should be mindful of?
Yeah. And so I could say the names, but the concept in it, let's say the one that determined the fair value standard, it basically says to treat the parties not as hypothetical buyers and sellers, but as fiduciaries to the marital estate. And so it's just an interesting concept. It's almost like, the standards of value book where you've got fair market value over here and value to the holder, and then fair value is that stuff in the middle. It's the idea where it's fair to the parties. It's almost like tilts it over to value to the holder. We're going to quantify what is this economic benefit to the holder of this cash flow off the business, and then that then becomes the marital asset. So like that's interesting. There's there's one that deals with what is the burden of proof if you're going to retain earnings in the business. Think like if I've got like it. Just think like Joe the plumber kind of business. It's a job, but I just happen to have $1 million in the bank. Okay, how much do you need to have in the bank if you're not taking a salary? And so then it becomes the burden of proof on the business owner to say how much needs to be kept in the business. So there are some things like that. There are cases dealing with discounts where, again, in that fair value context, it's loosely interpreted to say it's a pro rata share of 100%. Whatever you're valuing, just take a pro rata share of that without any discounts, unless the business is going to be sold, right? So if you got extenuating circumstances where one appraiser is at 0, the other person is at $4 million. Okay, what's the judge going to do? Let's just sell it. If the parties don't want to go to court in like the times of pandemic and you're that far apart, what's the answer? Well, let's just sell that thing. And in that situation, okay, now we can take a discount because there is going to be a transaction. So.
Yeah. And I mean, every single issue that you just brought up is treated differently in Missouri and treated differently in Illinois. And I think that that's an important piece, though, because as an expert, and even if you get into this line of work, and when I started to do expert witness testimony, I would assume that the attorney understood all the nuances of the valuation or the law, right? But that's not always the case because it's so nuanced. Even the fair value and fair market value concept, right? Traditionally in financial reporting or other kind of commercial litigation, fair market value includes discounts and fair value doesn't. Like that's just a simple difference. Mm-hmm. But the reality is it's based on the definition and how it's defined in the state, not necessarily how it's defined in the valuation community.
Right.
And so then it kind of, you start to layer some complexities in there that are not really always known. But let's talk about one thing that you mentioned, which is personal goodwill.
Yeah.
This is a concept, and I want you to talk about the concept. But most of the time when you get to a divorce with a business valuation and an owner, it doesn't matter what the business is. The business owner believes that the business is worth nothing without them.
What?
All right. Every single time. This business is worth nothing if I were not in it. But that's the segue into kind of what is truly personal goodwill. So let's talk about that a little bit, the difference between personal goodwill and company goodwill. Because I try to say one's attached to the person, one's attached to the company.
Right.
But tell us more about how that is important in divorce.
Yeah, for sure. And it's kind of back to that scale where you've got a person in a truck. On this side, it's a job, even think like hairdresser and a chair, all the way up to, multi-levels of management, maybe different locations in different states, a board of directors, things like that are tilted on the other end of the spectrum. But what happens when you're closer to a job, maybe you've got the business owner and a couple folks. At what point does it stop being in like an income type case and to where you have that residual or that enterprise or the company goodwill that you were talking about? It's tricky, especially the smaller they get. And one of the things I'm sure we'll talk about today is like the calculations versus conclusions. I testified to a business that had $250,000 of revenue. Why? Didn't make any sense at all. So certainly there was some more like conflict over and above like the business itself. And clearly that was it was a job, but it did they had a lot of subcontractors, so it did kind of factor in. But I think that understanding how the business works from what does the owner do? Is this the owner that I had this case where he lives in Florida and everybody else just did the work? And he was his LinkedIn profile was him with the shirt off, and he was a fishing captain in Florida, but he had this cash flow heavy business. And of course he was saying like, yeah, this is all me. Okay, so you got to understand what they're doing, how many other people are there. Is there any sort of way you can chop up the revenue and say, okay, this relates to your staff or other billers who originate the revenue? Is some of this relate to like the equipment? Think like a medical practice where they have an X-ray machine, and just try to chop it up into products versus services or whatever. And once you get that level of understanding and you see that the business owner is participating, but they're only responsible for, say, 30% of the overall revenue, and they've got 5 other people that make up the other 70% of that. Okay, now you may have a situation where there is some personal goodwill, but it's diluted by the fact you've got some other folks. And so I think the idea is if you're going to say you're a superstar, and okay, we'll give you superstar wages, but if that superstar wages takes the profit margin down to 0 or negative, that doesn't make any sense either. So if you are such a superstar that you could command superstar wages, there should be a superstar return at the end of the day. And so then how do you quantify that based off the benchmarks? And I think that's where you get into like the multi-attribute utility model. See some of that, like the MUM. That's definitely making a resurgence, at least in Massachusetts. I don't know. What about Missouri?
Yeah, we will see it in Illinois. But Missouri is a little bit different. So we have a couple cases that tell us to do a few things mildly different. So, but I think
they started in Illinois, right?
What?
That's where it started, is in Illinois, right?
Yeah. So, but I think that that's the issue, is how do you then quantify the personal goodwill? And the reality is every single state is different again. And a lot of it is subjective, so it comes down to the analysis, and do you have something that's supportable and that makes sense? Now, what I like about Massachusetts is when you're getting to value to the holder, that's logical. Like that makes sense. Like, what is the value of this business to this person as opposed to selling it outright? Because a lot of times this business creates the income and the wealth of the marriage and the family. And is there anything left over? Or is everything going to that person? But it does bring up some interesting pieces, because again, we've gotten a little bit off topic, which is fine. But in talking about fraud within divorce, let's kind of back up a little bit and start at the beginning. So you get some tax returns, you get some financial statements. What are you looking for to determine if there are indicators of fraud? Because just as we know that the business owner is kind of usually in control of all the finances of the business, and they may be telling their spouse like, oh, we're having a great year, oh, we're so successful. It could be that there's a lot of debt involved, but also you have, on the part of the non-moneyed spouse or the spouse that's outside of the business, you have a lot of mistrust. And so they always think that that spouse in the business is doing something to move the money and trick them, right? And so what are some of the things that you look for to see if that could be true?
Yeah. How long is our podcast?
Right.
So it's interesting because, we're just talking about like different states. And so let's say like Alaska doesn't have support purposes. So if you have this sort of seesaw or inverse relationship between, if you're going to give somebody a higher income and then a lower value, you have, it's just taken out of one pocket and put it in the other. Like, okay, cool. But if you're in a state where there's no support, then that difference on the value does make a huge consequence. So I just want to just like add that at the beginning there. But on the fraud side, there's ways to navigate this as a sole expert. There's ways to navigate this as a joint expert. In a joint expert, I just say, look, I'm not going to do forensic investigation. I'll do this valuation as is. If you guys want to hire somebody else and then come back later, cool. We'll just add that to the compensation. So whatever you can carve out off the financials once we're done, then that just becomes an income piece. So that is one way to deal with it. Let's say you are just a solo hired on one side. If you're the business owner side, well, you're probably not looking too much. And the reason I wrote that article in the Value Examiner was kind of dealing with that. Was I had this is a hypothetical situation, right? Had a situation where the business owner's expert said, "Oh yeah, there's nothing to see here, folks. It's just a book value sort of analysis, except that we like the income approach better, and the income approach was producing a value that's less than the asset value." And I'm like, that doesn't make any sense to me, but okay. Whereas I was on the outside, so here I am seeing, you walk the parking lot and look at the fixed asset list of this 100-year-old business that's steady. It's in a boring industry, let's put it that way, right? That there's not a lot of like hockey stick kind of growth. It's just like slow and steady, and yet that doesn't make any money. So you see this, lots of luxury vehicles, lots of evidence of on the tax return. And granted, we didn't get a lot of information. There's just kind of like peeks into the general ledger, but you do see like non-deductible country club dues. I'm like, okay, so here you have a situation where the business doesn't make any money, and yet it's able to blow a lot of discretionary spending at these family members. And this was like a 4th generation business. So family members are just kind of scattered throughout this thing. So you have the situation where you could either like get it through the general ledger, should that be available. One of the reasons why I like divorce is you can get at the personal side. Whereas if it was just, say, you're looking for forensic, like fraud in the financial statements from a shareholder dispute, you might not get everything if you're representing the minority shareholder, right? But in divorce, you could say, all right, give me your personal bank statements and credit card statements. Let's see the volume of spending that you live off of, and then we'll compare that to what the business is producing. And oftentimes that's it right there, because you can see this big disparity, and then we're done. Right. Otherwise, it is looking at, like, I don't want to say like individual like receipts, because like how do you deal with a Costco receipt and you're a contractor? They have a real nice house, but like it does look legit on the surface. So there is ways where what I address with that is to say, okay, these are category 1 type discretionary spending. This is a casino charge, right? This is your trip to the Von Trapp Lodge in Vermont, etc. So those we would definitely add back. Then there's a category 2, which would be, say, like the Home Depot charges or something that looks sort of business-like, but there's a lot of them, or maybe there is some overlay between the personal side or whatever, and then we just quantify those. And then what you could do is just say, here's the range. We know that we're going to add at least this much back, but we may add this much back. And then you kind of issue that range of value and work with it that way.
Well, because I mean, that's part of the process, is that when we're initially engaged to do the valuation, we are not there to do any forensic investigation. But I think part of what a lot of experts are doing is we're kind of looking at the personal bank statements. Okay, what does the cash flow look like there? Then let's go over to the tax returns. What does the cash flow look like over here? Internal financials, which could mean, QuickBooks or the general ledger, or, their internal fixed asset listing. What does that mean for cash flow? And when you have discrepancies, you may say, okay, and you have a spouse that's saying, oh, they run everything through the business. And I know that, and they're taking in cash that I know that they're not booking as income. Those are all red flags, but they not always result in some huge amount of difference in the value that is provable, right?
Right.
So that's the rub. Now, I do tell clients that defrauding the IRS is going to get you in more trouble than defrauding your spouse. And so, if that the tax returns were not done properly, or may have some additional items included, that's a big deal. But the amount of time and effort that it requires to go down that wormhole, if you will,
Mhm.
it I think would surprise business owners. So it's like, well, just go through all the bank statements and see what's personal. That's not an easy process,
Yeah,
right?
they want the work done, but they don't understand that it's going to take $20,000, and then you might not find it anyway because you're dealing with a landscaper that has snowplow revenue. Like, well, good luck figuring out the cash on that.
Right. Right.
Yeah,
And again, there's red flags, but there's also ways, like sometimes we'll look at industry reports and say, okay, a landscaper should make about this at the bottom line.
yep.
And sometimes it's like you would need to go and find 20 or $30,000 a year that's being misappropriated or something,
Mhm.
or kind of fluffed up expenses to have it make a significant change in the value. And so I think that you might spend $20,000 to have a result of a $20,000 difference, and
Yep.
there's no cost benefit there, right?
Sure, and that really is the genesis of that article. So the article is basically dealing with profit margin adjustments, or at what point do you withdraw from the engagement because there's just not enough evidence to make you feel comfortable about concluding on the value of the business. So to your point, if you've got a situation where this business has been around for a long time, it doesn't make any money. It's like strange how they can stay in business and don't make any money, right? That what we could look to is like the industry data, and the more the merrier. It's not just enough to go to like RMA. Well, why don't you grab a whole bunch so that if they can get you unhooked or dislodge you from your RMA position, that you still got 4 other industry sources to kind of support your adjustment. So the idea behind that profit margin adjustment is to say, look, if you're coming up with the value that's less than book value, clearly there's some room there. You can legitimately get it up to the book value without even looking to the industry, because theoretically this stuff should connect, right?
Hmm.
But then if you look to the industry data and you say, all right, well, everybody else is making 5, 6, 7%, and you don't make anything. You don't want to adjust 20% profit margin, because that doesn't make any sense either. And again, it needs to have that linkage between superstar person and profits at the end of the day. So, but not so much that you are sticking your neck out further than everybody else in the industry to pull off some sort of profit margin like that. So I think if it's almost like the red light, green light, yellow light. So
Mhm.
if the green light would be adjusting up to the book value method, the yellow light would be to rely on some industry sources if it's backed up, and then the red light would be don't go there because it's just too dangerous to try to defend that stuff.
Well, and I think that most business owners in general are trying to lower their tax burden. Like that's the goal. You come at the end of the year, let's buy a bunch of stuff because we don't want to pay taxes on it. So it makes sense logically that those things would happen. But let's just dial it back one step and talk about book value. So
Mm-hmm.
what is book value? Because we've mentioned it a couple times, and I know that not everybody totally understands.
Exactly. Yes.
Yeah. So let's
Thank you.
talk about book value for a minute.
Yeah, I like to explain it as to this: what you own minus who you owe. That difference is that book value. It's almost the floor value, like the liquidation value. If you and we take a snapshot, usually it's the end of the fiscal year, right? So December 31st, we take a snapshot of your assets, your inventory, your fixed assets, minus your payables and your debt, all that stuff. Whatever is left over, that's your book value. Sometimes there may be some adjustments, think like a real estate appraisal or some things like that. But that's, to me, it's your walkaway number. It's like, well, why would you take anything less than that if your assets minus your liabilities under a liquidation premise can get you something higher than what your income or even the market approach is calculating? So, and again, I guess again, haven't said it yet, but we would go back to like that revenue ruling 5960, where it's just the common sense aspect. It's, common sense, informed judgment, and reasonableness. Is it reasonable that you would take $20,000 as the value for your business, because that's what it's coming out on the income approach, when the book value or that liquidation is $500,000. No, I'll take $500,000. Thanks.
Right. And it's a concept that I think people understand because book value is kind of like equity. And so if you take assets minus liabilities, you get to equity. You get to what's left over. And then you sometimes we have to mark that up to fair market value. So like if you have a piece of real estate that's been fully depreciated, but it still has value, then we would go in and kind of mark it up. And it is the floor. Most of the time we're brought in to see where the actual value is if they were to sell, if there was a hypothetical willing buyer and willing seller, or whatever other standard is in that state. But I think that if we so that's what people can kind of see easily in the financial statements of what their worth is.
Yeah.
But then we talked about looking at some of the bank statements. And so if we're looking at the bank statements, be them personal, because I'll get personal and business bank statements and business credit cards. So if we're looking through the bank statements when we're doing like an income and expense analysis for the purpose of maintenance and child support, what are we looking for, again, as either red flags or maybe just an area that we have to ask more questions?
For sure. For sure. So yeah, one of the things that's key in a forensic investigation is to make sure that you have your hands around the complete population. So getting the personal and getting the business bank statements and credit cards, like that's so important. And then the first thing you want to do is reconcile the transfers. So if you could see that they're taking distributions or taking money either from a loan, shareholder loans, due to, due froms, whatever. There may be a couple other entities involved, but if you could see that linkage between all the known accounts and that the transfers out reconcile to the transfers in, okay, cool. Step one, check. But a lot of times that's where you find the missing accounts. And I had this all the time. I actually had a trial where I had a husband who was pro se, basically zero out all the accounts. And I'm like, well, okay, Your Honor, this is where the trail goes cold. But we did find 9 other different bank accounts or investment accounts too. And then he was a little like off because he's like, well, did you find this one? No. Did you find this one? So he asked me, did you find these 4 other accounts? I'm like, dude, you're crazy. But okay. It's like, yes, you really got me there. Like, glad that's on evidence. So understanding the flow is so important. Then I'd say, the next thing is just to like read it like a book. Some of these pages or statements are 20 pages long. Okay, well, it's not that you need to read individual line items, although that might help, but just visually, what does it look like? And Chris said it the last podcast. What's the definition of forensic accounting? It's the art and science of investigating people and money. So just visually, you can get some ideas of what makes these people tick just by like, oh, every Wednesday they go to the ATM and take out $800. I had this case that in a 6-month period, the husband took out, like some days it would be $800, some day it'd be $3,000, but he amassed $1.1 million of just cash. And I figured it out. It's 2 10-foot stacks of $20 bills, cash.
It's crazy.
It's crazy, right? So, but again, like just understanding the bank statements. Oh, here's another $800. Oh, it's another $800. So you want to just be able to spot the anomalies. So in auditing, you're looking for, does things check? Does the date reconcile to the general ledger? Does the amount and the pay, et cetera? Whereas in forensics, we're looking for those anomalies or what's different. And so what I'd say a bigger trend in the last couple of years, something that's a hobby of mine, is looking for cryptocurrency withdrawals. So it could just be this little like string of numbers that has a BTC or ETH in there, and like, wow, that just disappeared. Guess that was a debit. They bought a bunch of juice at the coffee store or whatever. Or it could be that they're buying cryptocurrency and that there's a whole nother account or investment pile sitting out there that nobody knows about because nobody else knows how to like operate a computer.
Well, and I think that a lot of times in divorce, the one spouse will say, oh, that other person is so crafty, like everybody loves them, but they know how to get it over on, and you'll never find it or you won't see it. The reality is there's usually a trail, unless there's cash coming in that can just kind of be away from not even come through the bank. Sure, that's right. But there's not a lot of situations where there's heavy cash coming in anymore,
legally,
like serious heavy cash. Well, yeah, legally. But what we're looking for also is like round numbers, trying to see transactions to go into other banks, like you talked about, or checks written to people that we don't necessarily know, things like that. Income coming in that comes in quick and then leaves just as quick. Half the time I'm telling the clients to start taking a look at your own bank statements. Like, you are there, and then it's kind of establishing a threshold. Like, I'm going to look for things $100 or $500 and more, right? Just to first see if I see any red flags. And if I don't, then maybe it's at a smaller level. But how much of that smaller level would we have to do to move the needle? And what would be the cost involved in quantifying those pieces?
Exactly. And that's where I think practitioners that are looking to get into this area, or the folks that are listening to this, like, how do you deal with this open-ended forensic issue where somebody comes to me and says, all right, I know there's something there. You got to find it. Okay, I could probably find it. I don't always find it, but it is looking for that needle in this haystack. And so this haystack could be a $50,000 pile of fees. Do you really want to spend $50,000 on this? Or should we start small and say, what is it worth to you from an opening budget perspective, from a go, no go deal? So if I spend, say, $2,500, look at those bank statements and reconcile the transfers, look and see what's going on in the general ledger. Okay, from that review, then I could be like, wow, this looks a little weird. I want to do these other three things for another $2,500 or another $10,000 or whatever that is. But I think the successful path through a forensic engagement is those little bites. Because otherwise, like, the worst thing I can imagine is I'm trying to send somebody a bill for $20,000 and I didn't find anything. And they're like, well, why should we pay that? Well, because I looked really, really hard. It's just not there. And so both sides are going to be frustrated, and you probably know how that's going to end. So.
Right. Well, and sometimes we'll even just start with 1 year. Like, we have a recent year, but like, let's say we have 2019 tax return, and we have 2019 all of the personal bank statements, and we have 2019 all of the business bank statements and the credit cards. Like, let's take that 1 year and see if we see discrepancies in all of that data, because usually the things that somebody would try to manipulate are going to be leading up to that decision to get divorced. So it's going to be right prior, 6 months, 12 months prior to filing divorce or telling the spouse. And so then we can say, okay, if something is going wrong here, how does that compare to the prior year? And it's taking it step by step, because that's the unfortunate part, is we don't find anything. It still costs a lot to get there.
Exactly. And you bring up a great point, which is, how far back do you need to go? But I think the answer to that lies in, you need to get some baseline. So usually in divorce, we'll just say, like, when did the marriage start breaking down? Oh, 4 years ago. Okay, we should probably go back like 5, 6, 7 to get that baseline. And if you could see, like, from a business, all right, the business normally turns over $20,000 a month prior to things starting going bad, and then you just see it go boom, it just drops off altogether. Like, okay, maybe, is there another business license in the girlfriend or boyfriend's name, or the roommate's college buddy's name, that we need to do some more digging that to explain this drop off. And it's also recognizing, like, don't kill the golden goose. So in a forensic investigation like that, in a true, like, business context, okay, let's subpoena those suppliers. But if you do that in a divorce, you run the risk of, the perception, oh, so-and-so is getting a divorce, maybe I don't want to do business with them anymore. And now the whole thing starts to crumble. So there is you just got to be mindful of, once you start sending subpoenas to the customers or the suppliers, that's a different level
Yeah.
of just like looking at the bank statements. You get more comfort because it's third parties. The third parties aren't gonna, well, maybe they're less likely to show manipulated documents, so you can trust those more than like the QuickBooks or even photocopies of the bank statements, unless you're getting those bank statements straight from like the control type folks, like the financial institutions. Yeah, we'll trust those a lot better. But yeah, it's kind of that tightrope where you want to do a good job, you want to find it, but at the same time, you don't want to make such a mess of things that, when we're done, there is no business and everybody hates each other. I mean, more than they already do.
Well, and I think there's talking about the golden egg. I think that's an important piece. And you've kind of touched on it throughout this conversation, that there's this concept of a double dip. And it has to do with, the salary in the business valuation and then the income available for maintenance or alimony and child support. So let's talk a little bit about that so that people can understand that it really is like this pendulum, that we're taking money out of this basket and putting it into this basket, but we got to make sure that we're not doing this double dip. So maybe you can explain that to us.
Yeah, it sounds like you've had this conversation a few times. Yeah. Yeah, I think the example we could work with is, let's say that there's a business owner that the business itself before compensation generates, $1 million. And lo and behold, that business owner takes $1 million of salary. So there's no profit at the end of the day. But we determine, because there's enterprise goodwill, or this company goodwill we were talking about, that we want to take some of that $1 million and put it towards the value calculation. I'll do like 600,000 for the business owner, 400,000 for the business, right? So at the end of the day, I'll come up with my value of the business, and then theoretically, we would use that $600,000 salary to the business owner as their reasonable compensation. But what happens is people see that $1 million that's coming out. They say, okay, Jason, we'll take your value number, but we also want to take that $1 million. But it doesn't work, because we saw like there's zero profit at the end of that. As we know, like making adjustments one way swings the value up or down. So that's the double dip, where we would take a high value and take that high compensation and use that same $400,000 incremental salary that I'm saying is the business side, that we're adding that back to the business owner's salary and double counting it. Obviously that's a problem from a business owner's perspective, but it's just, we want to make this thing fair at the end of the day too.
Right. And it's just a process of that. If we're looking at income in general from a business that then flows to an individual, that we can't count it in two different places. But it's a concept that's way more sophisticated than that, but that's the general gist of it. Now, one more little topic item, and then we'll talk about you and your firm and your background. But you've actually written a lot and presented quite a bit about calculation reports in the context of divorce. So let's talk about this topic, because it's very important in the valuation community, but how does it really help, attorneys and business owners?
Yeah, and it gets people's attention.
They get riled up.
Right. And that's kind of the way I approach this stuff. So I'll find a topic that I think has enough interest, and then I'll just kind of do some research on it. And in this case, there was a lot of banter going about on the business value BV update, like back and forth between industry experts, and people have very strong opinions on both sides. Like, never do a calculation in a litigation setting. And on the other side, yeah, it's okay, but not ideal. And so at what point does that, what point does the experts then make that decision for themselves? And so what I did last year at the conference, I just did a survey of all the calculation cases that I could round up. And what I found, and then I did a survey too, and what I found was like the people were willing to do it, willing to testify to a calculation, they were saying yes, that they like the concept of a calculation, but just only half of them, less than half, would be willing to testify to it. But what I think gets a bad rap is just all the initial court cases that came out right after the SSVS or the AICPA's valuation standard. Once that came out, I think it had the added benefit of weeding out some of the practitioners that were abusing the system. And so what you had was a number of court cases that dealt with like rules of thumb, like, oh, I'm going to just do a rule of thumb and I'm going to go testify to it, or a mechanical calculation. I love that term. We could come back to that. Or I'm just going to do a calculation off the buy-sell agreement, et cetera, right? So all of those were rejected. Okay, then the next crop of folks said, okay, well, there was a joint expert, and so where you had basically like one calculation on both sides. And then there was another case called Hipple where, they recognized like, hey, the AICPA says the calculation is a reputable method, or like really, I guess, approach that now we're going to accept it. And so then the next category is really the reliance. And so when you are not directed by the client, where you're not limited in your scope of the procedures to just say, just limit yourself to this buy-sell agreement and call it good. If you have the ability to do your own analysis, that there's some cases, including one in Alabama, this rolling case that dealt with the acceptance in that state, and that was an appeals court case. And so like the court said, yeah, let's look to the weight of the testimony from a calculation rather than its admissibility. And that just came back around the Bollard case in Alabama this year that says, oh yeah, instead of overturning that rolling case, we're going to stamp it. It says calculations are okay. And personally, I've testified to 5 calculation reports, and I've got another one next month. So what I think we as practitioners need to be aware of is that the demand is there. As we've seen, especially during the times of the pandemic, people don't have a lot of money to spend on this stuff, or it just takes some of the fight out of them because they can't get into court for another year. Okay, what's the solution? Okay, well, either do a calculation or or not. But I think the takeaway is that there's a demand, there is a service that we could provide for our clients. There is situations when it works. Obviously, if I have a calculation and you, Melissa, have a conclusion of value, I don't want to be the one going into court without an opinion. I could have an opinion that my calculation of value that is my calculated value, but I don't have an opinion like, here's my conclusion, right? So there needs to be some parity that goes into the decision, but certainly you could start with the calculation and then upgrade as necessary. But that's what I think is a bigger issue, is that this isn't going to go away. And as practitioners, we need to be responsive to the demand and then just meet that demand in a responsible way. And as we see, like it's more to the weight of that testimony rather than the admissibility, because it is, there's lots of discussion and court cases that have accepted calculation of values, and that we should just be aware of.
Yeah, and I think it's, the nuances of calculation of value versus conclusion of value is sometimes lost on the average reader listener. But I think it's an important piece that you should talk to the valuation expert that you're working with and see their comfort level on those different, and see their perspective on those different options. Because some people, you're right, are just not willing to testify to those. I think they're used a lot more in M&A and with business brokers and mergers and acquisitions. I use them, so I think that there's always ways to lower the costs for a client, but you also have to bridge the fact of, is it the most cost effective method? And it's based on the individual, the case, the expert, and all of that. So we bring it up, like we could talk the entire hour on this, but and maybe we will for another podcast, but it at least brings it up that it's an issue and that you should address it with your own valuation expert, because you and I probably have different ways of looking at it as well. But this has been so good. We've covered so many topics. I love it. But why don't you tell us a little bit more about your background, your company? You have like 18 letters behind your name. You have like, you just write and present all over the place. You work for the NACVA just like I do. Like, just give us a taste of the amazing things that you're doing.
Well, thank you. And yeah, this hour is just like flew by like that. So I definitely think we could continue this conversation for sure. Yeah. So as I was saying, I kind of happened into this profession, and as you could probably tell, I don't want to say I'm a Boy Scout. I'm certainly a nice guy. And in a world where I describe litigation as like the Michael Jackson "Beat It" video, where they have each other tied up by the wrists and each of them have a knife, and that works as long as everybody's dancing. But every now and then you're just going to get stabbed and it's going to hurt. And so like litigation is not a pleasant place sometimes. So I think at the early on, there was a few times where I'm like, tax returns sound pretty good right now.
Right.
But give me the weekend and then Monday morning, I'm usually right back at it. So I think for me, the appeal is to see the trucks driving around like, oh yeah, I know that business, or I see that place. And I just love connecting the dots on how the economy works, and so that and making one-sided entries is just a lot of fun too. But yeah, so I started in Alaska, as you heard, and then I met Mark Bello at we were teaching for NACFA in Florida, and we just got along real well. This was 2008, and he was looking for somebody about the same time I was getting a little frostbite and looking for a change. So the short version of that story is nobody blinked, and it's been 10 years.
Wow.
3 days ago. Yeah. October 1st was my 10th year in Massachusetts. So yeah, like work for Edelstein and Company in Boston, and
Watson.
yeah, and do a fair amount of different types of activities, including like some of the stuff we didn't talk about, like the criminal side of things. Just my old boss used to call me a mutt. So I know a little bit about a lot of stuff. And I think because we do, as practitioners, see just a lot of different kinds of businesses, I don't need to know how to do plastic surgery to value a plastic surgeon business. And so I think some of the lessons learned on some of the previous cases, especially when you go embarrass yourself in a trial or in front of like teaching, like embarrassing yourself in front of a group of people, there's nothing like that to help you remember it for the next time. Like kind of just burns in your brain, right? But that's, to me, is part of the challenge and part of like my progression. I love learning. I love meeting new people and learning new stuff. So yeah, that's what just keeps me coming back for more and trying to just survive. I in that one of the conference presentations I did, I describe our profession as like the World War I stretcher bearers. Like we go out there to the battlefield trying to dodge bullets and do what we got to do and get off the field without getting shot. And if we could do that successfully, then it might not be very pleasant during, but after, then we could look back and like, that was pretty cool.
Yeah.
But yeah, it's a hard profession, but certainly very rewarding.
Well, and I think that's part of the process is, litigation is not for the weak of heart. You really, I was remembering some of my first ones and I was like, oh, those were so horrible. I would almost get like physically sick, like it was the worst stage fright. And then, after you do years of it, you finally are like, okay, I think this is I can do this. But
Oh, yeah.
I've really appreciated all of the information that you've provided. It's given me even some different ways of looking at things. We're going to provide your information of how to contact you, email you, call you. So if people have questions, especially if they're doing divorce on the East Coast, I think that you're a great resource. And I know that you're always willing to help people. So they can certainly reach out to you. And I think we'll probably have you on again and talk more about forensics and cryptocurrency and all of these fascinating topics.
Right
So
on.
we appreciate it.
This was a lot of fun. Thank you, Melissa. You're doing a great service with this podcast. I really
Oh,
appreciate
thanks,
it.
Jason. I appreciate it. We'll
All
talk
right.
to you soon.
Okay.
Thanks.
All right.